Well, thanks for joining everybody today for the identifying fraud teach-in. We thought this would be helpful for everyone that's going to be working on the cases. We think that this document, while it doesn't cover everything and obviously is not the end-all be-all for what your work will entail, this will certainly point you in the right direction, let you know the key things to look for when identifying cases, when looking for investment frauds, and it will also help give you a framework on how to build a strong case filing. What we want to do here today is basically know how to identify and recognize investment fraud. That would be Ponzi schemes. That would be any sort of guaranteed returns, turnkey, fix and flip, real estate frauds, you name it, they're out there. We just looked at one recently here that was whiskey. You got the chance to invest in whiskey in a warehouse. So there's no shortage of scams that are out there. They're all gonna be a little different, but they're all gonna have some of the same, many of the same characteristics. I'd like you to think about this much like shoplifting. Shoplifting, roughly in America, the losses are about the same as Ponzi schemes. So when you look at shoplifting as a whole, everything that's stolen from a store via shoplifter, that amount every year is roughly the amount that we see taken in Ponzi schemes. Obviously, the big difference there is shoplifters, that loss is spread among lots of fraudsters, while Ponzi schemes, that amount is much more concentrated to a few bad actors. We're also going to take a look here at tactics used by fraudsters to lure investors, as well as we're going to look at some ways for you to identify bad actors. Lastly, we're going to touch on how to build a strong whistleblower case filing. Just a quick touch on, why you'd want to get into this. Investment fraud, it has a huge negative impact on society. Some of these frauds can be quite large, and they can do a lot of damage to the social fabric of the community, whether that be universities, charitable foundations, and other organizations that have given money or invested in the fraud. They can be impacted, which will then impact the charitable endeavors that those investors could have done in the society. Obviously, victims, they lose homes, their savings are impacted. A lot of these fraudsters hide their wealth offshore. To the extent they're not paying taxes, that tax burden falls back on us. And quite frankly, I like to level the playing field. I'm a fund manager as well, and I don't like to see fraudulent fund managers on the playing field. I like to tell the ref when I see something bad going on, and hopefully they can throw a flag and get that person out of the game so that the good players can go on and play a fair game. Also, there's the potential awards that can be had by working in this space and filing whistleblower cases. We typically see the most frauds in Ponzi schemes and real estate scams, as well as trade finance, oil and gas, and more recently, cryptocurrency. A lot of these will be under different names. So you'll have a Ponzi scheme that's doing high yield securities. So they're guaranteeing 10%. If you leave your money in for 5 years, you'll get 10%. If you leave your money in for 7 years, you'll get, 15%. And these Ponzi schemes are essentially can have different names. These real estate scams can have different names. Fix and flip, hard money lending, real estate funds, mortgage notes. They can call them what they want, but at the end of the day, it's shoplifting, no matter how you do it at the end of the day. So they're going to all look quite different. They may have different names. They may go about it slightly different way, but at the end of the day, it will all be either one of two things. A pure Ponzi scheme where the money is not being invested, no monies are being invested, and there's no way to generate a return because no money is being invested. And the investors, earlier investors and current investors, will likely be paid back from future investors. That's the most egregious. Typically what we see is some sort of a hybrid where the fraudster will take in 10 million, they'll put 7 million into investments, some sort of investments, whether it matches the stated investment strategy. Sometimes it does and sometimes it doesn't. But the other 3 million, for example, of the 10 million will just go into their pocket, pay for homes, pay for the Ferrari, jewelry stores, high-end restaurants, etc. So lots of times it's not a pure Ponzi scheme, it's more of a hybrid where either the fraudsters are not investing in what they said they would invest in, or they are not investing all the money that they took in from investors to invest in what they said they would invest in. So anyway you cut it, once that happens, we have a case, and we typically see these in trade finance, private credit, real estate under various names, Ponzi schemes, as well as oil and gas wells. Now, essentially the only way to attract an abnormal amount of investors into something that seems weird is if you lie to them, if you make misrepresentations. Those misrepresentations typically include statements that the returns will be above average. So it's unlikely you're going to run down to the corner or hang out in front of the bank and lure people into your investment. They've never heard of you. They don't know you. The fraudsters typically have very little background or experience. It's unlikely that person would invest with you to obtain the market return. Remember, by definition, the market return is what most people are going to end up with, even if they try their best and do everything right. Most people on average are going to have the average return. Most people are average by definition. Most people aren't exceptional. Most people aren't total losers. Most people are average. So in whole, if you just invest with the average person, to the extent they do what they said they would do, invest in market-based instruments, they're going to generate the market return, plus or minus. But that's not too exciting. And that's not going to get people away from their funds at T. Rowe Price, Fidelity, and Vanguard to invest with you. So how do you do that? You do that by promising huge returns with little risk. You do that by tapping into the greed factor for investors. Another way that makes that easier, remember, these fraudsters typically don't have stellar background. Typically they have checkered past at best. So they like to target familiar groups, affinity groups, religious organizations, which helps to build trust just by being a part of that organization. So whether you be a part of the Jewish community, you could be living in an area that has a large Caribbean community or a large Italian-American community, or a religious organization like a Catholic church or a Baptist church. You may be able, well, you would be able to gain trust from those people just by virtue of being in their circle. People assume that people in particularly religious groups with them are unlikely to commit fraud against them, and the fraudsters actually prey on that sentiment. Again, they offer large above market returns, and again, oftentimes you can achieve an above market return if you take on excess risk. But again, that doesn't sound too attractive to people, many of whom are elderly. Many of these victims have been burned before. So promising huge returns is one part, little risk or no risk, oftentimes, the quote unquote guaranteed returns is what we see from fraudsters. This is what lures people into the scheme. These jokers, characters, whatever you want to call them, would have a lot of trouble luring people into their scheme if they actually use their own track record, which would be none, or if they actually used a real track record. Oftentimes they don't have the skill to invest, so their track record would not be stellar. It certainly wouldn't show low volatility or low risk, and they'd be unlikely to attract investors. One thing that we saw with the Madoff scheme, and one thing that we saw with the most recent fraud that we filed on, which was Whiskey Wealth Club, was these investment schemes oftentimes not only tout the investment, but they tout the ability or opportunity to be a part of a privileged club, to be a part of a sort of secret society, not to go that far, but, Madoff would oftentimes turn down investors the first time as a strategy to lure them into the fund. He would not accept their money. And that would just make people want to get into it more. Oftentimes, many fraudsters will limit the investment early on to their victims, knowing that limiting the investment will oftentimes lure a larger investment from someone down the road. With the Whiskey Wealth Club, this scheme was a scheme to invest in wineries and to invest in high-end whiskey. So they had whiskey tastings. You got to go to, if you were in Italy or the UK on vacation, you could stop by and visit a winery or visit this event, and it made people seem more affluent than they really were. They had very little investment knowledge. And when you layer that on with someone wanting to be affluent, wanting to feel affluent, quite frankly, the Whiskey Wealth, the Madoff scheme really preyed on that for the investors. You'll often see words that fraudsters will use that will try to send the signal that something is low risk. Most people consider something short-term lower risk than something long-term. So oftentimes these will be short-term, you'll get a very high monthly return, you'll get a very high one-year return, and it really gives the investor the idea that the investment is less risky if it's going to pay back sooner. Now, again, you haven't received any money 1 month, 3 months, or 1 year out. But as an investor, a potential investor may fall victim because they'll see that this is short-term, it's being touted as a short-term payback, and it'll seem less risky in their mind. So short-term, monthly, short-term note, something that you'll see a lot. You'll also see a lot of the words trust. I'm selling trust notes, or, trust certificates, or, these words that trust, it's words that people associate with life insurance companies. It's words that people associate with banking. And it makes it seem like it's guaranteed by a bank. So they'll use these catchwords, trust notes, certificates of trust, trust deposits, to really send the signal, in addition to it being short-term, that it's somewhat guaranteed or perhaps has the backing of a bank or insurance company when it does not. The easiest way to keep a scheme going, an investment fraud going, is if people have trouble uncovering it. And typically, many of these investment schemes revolve around assets or investments that are in remote locations, right? So it'll be gold mines or some sort of mine. One of the biggest schemes ever was a Bre-X scandal. The Bre-X scandal was the largest gold mining scheme in the world. It duped thousands of investors out of billions of dollars. And all the gentleman did was he went to Indonesia and he found a Filipino geologist and he found a Canadian investor to back this scheme. And what he did was when he got out into the middle of the jungle in Indonesia, he took his wedding ring off that was gold. And then he took a nail file and he filed parts of his gold wedding ring around the area that was supposed to have the gold mine. So when they took the soil samples from this area close to what was supposedly this Indonesian gold mine, the gold shavings from his ring, along with a crooked geologist from the Philippines, he was allowed to put out reports and put out press releases that this was a very prolific gold deposit when it was not. Very hard for investors to verify. You could go to Indonesia. You could hire an independent geologist to go to Indonesia, either of which would be very costly for you, and you likely wouldn't do it. particularly when the good news is coming out, right? These guys aren't putting out bad news, they're putting out good news. So this is something else that makes it unlikely that, people may not verify it. Oil and gas wells, even if you did make it down to Texas or Oklahoma, wherever they claim the oil and gas well was, even if you did find the well, it's unlikely that you would be able to ascertain two things. One, how much it's pumping, and two, what's under the ground. It would be very costly for you to do either of those, and without relying on information from the sponsor, the fund sponsors, it's going to be very difficult for the average person to verify this, and it'll make it easier to perpetuate a fraud. Revenue from remote countries, countries you've never heard of, countries in the middle of nowhere, mines in Guinea, investments in Mauritius, certificates from the Bank of Nauru. These will all be things that will be touted as part of these investment schemes. Trade finance, private credit, things that are allegedly stored in warehouses, commodity-based investments, very hard for the average investor or any investor, quite frankly, to verify. Along these lines, we have the schemes of ATM machines. Several years ago, you had people touting, you could buy, put a few thousand in, and they put an ATM machine in various locations for you, and you get the cash flow back from that. That's, again, an investment that's very difficult to verify and would ultimately likely end up being a Ponzi scheme, as the fund sponsors realize that it's practically no way for the investors to verify where their machine was and how many people were using their machine on a daily or monthly basis. Asset-backed investments are ripe for this type of fraud. They're typically, they'll say, hey, I'm loaning against aircraft that are being leased out to Singapore Airlines, and you can try to call Singapore Airlines to verify. There's chances are you won't get any comment. Chances are they won't know what you're talking about. Either way, it's tough for you to verify. If you can't get any comment from the ultimate user, it's very tough for you to go and evaluate the fleet of aircraft, et cetera, to guarantee that your investment's actually there, these asset-backed investments. Again, many of these things are stored in warehouses, and while there should be a collateral manager, an independent collateral manager, all the banks use them, all the trust companies use them, Goldman Sachs, Deutsche Bank, they all use them. Fraudsters typically don't use them. And if fraudsters use them, they either use unscrupulous ones or they won't share with you the reports that are provided from the collateral manager, making up an excuse or delaying if you were to ever ask for those reports. Enron's a prime example of this. Enron had many SPVs, special purpose vehicles, partnerships that it had set up, related party entities that claimed assets were barges in Africa, power plants in Mongolia. The point is, this is something very hard for the average person, even with a legal team, to get their arms around all the documents, to get a hold of the documents first, and then to start verifying the value of the collateral underpinning the documents, and then going from there to make sure that everything's on the up and up. It's very costly. Investors don't have the resources to do it, and fraudsters know that. Anything complex should raise a red flag. The truth is usually a simple thing, and anything that's overly complex is something that we want to look at more closer when it comes to investment fraud. Complex business structures, org structures, lots of boxes and arrows on who owns the assets, where the flows are going, where the cash flows are coming from. It should be very simple. Again, the truth is a simple thing. Madoff, more recently, these cryptocurrency guys will tout algorithms or proprietary trading systems. They'll use a lot of big words, stochastics. They'll use a lot of words to talk about their algorithm. And it'll just be confusing for most people and hard to verify at best. The point is, if it's too complex, that's a red flag in and of itself, and we want to give it a closer look if we're working on the case there, and really try to deconstruct where the cash flows are coming and going. When you look at private equity and private lending, where we see most of these shenanigans are related party transactions, straw borrowers, where they just make up a fake company that's supposed to be a customer, and they're loaning the money or giving the money to themselves. That loan will never be paid back because, again, remember, it's a straw borrower, it's a shell company, which has no assets or operations to generate cash flow to repay the loan. So once that money goes out the door, it's usually gone. Typically, these private equity, private lending guys, they like to tout that all of their deals will be collateralized. They like to tout that they have rigorous due diligence. And what we see when we typically drill down into the actual loans, the related party entities that may have been set up, we find out that these loans are often uncollateralized or under-collateralized, and often to related parties, sort of robbing Peter to pay Paul oftentimes. Asset-backed investments, typically these guys, these fraudsters will make up stories or make up excuses to refuse to provide information. They may say it's proprietary. They may delay by saying, let me check with compliance when you ask for the data. And then when you press them more, they may come back and say compliance can't share that. And they can actually typically give you a pretty flashy or believable reason. But at the end of the day, refusal to provide information or no third-party verification of the assets or investments, huge red flag. And we want to list that as such in our filings. There's a company that said, hey, look, you can make a lot of money if you buy bus stop shelters. What would happen here? You buy bus stop shelters, 5 of them. You let this company Metro display advertising, get people to put billboards or advertisement posters within your shelters, and you'd make money from the fee there. That was a obvious Ponzi scheme. There was no way for you to get out and know the exact location or bus stops that you had. There was no way really for you to verify the ownership. You could try. It's not that costly, but it would be challenging for you to do it across the whole portfolio. Remember, if these guys said they had 10,000 bus stop shelters, let's say you did 300. Well, after a while, it gets costly to check all 10,000. So even if you made a good go of it, it's still ripe for it to be a Ponzi scheme. Any lack of information, refusal to give information, excuses or clauses in the PPM or offering documents that say that investors won't have information, that's a red flag and should be listed as such. And you should delve in to the reasons why they're not providing information and put that into the filing. When you look at standard red flags to watch for, it's the kind of big 5, I would say. I didn't realize there were 5 here, but I would say these are the big 5. There's others, but these are the big ones. Fake returns, straight line returns, returns that aren't believable, returns that are too high for the stated investment strategy, returns that display absolutely no volatility at all. It just doesn't happen in finance. If these guys were that good delivering these stellar returns, you would have heard of them already. These guys aren't that good. They're lying about the returns to attract investors. They're guaranteeing the returns when they have no balance sheet to do so, no capital resources, the financial resources, they don't have them to make the guarantees. So these 2 things fall into the next bucket of misrepresentations. They've misrepresented the returns. They've misrepresented where the return is coming from. They've misrepresented oftentimes the value of the assets, and they've misrepresented the ability for them to satisfy a guarantee. So the more misrepresentations we have that lead someone to invest, it makes for a stronger case. Now, oftentimes these bad actors, this won't be their first foray into a life of crime. Oftentimes they've had infractions in the past, and that's when we use our personal background checks to find out, and Google, quite frankly, you can Google these guys' names. You can look on LinkedIn or get a hold of their bio and see where they've worked before. You can Google the firms that they've worked at before. Oftentimes those firms would have had infractions or perhaps sanctions by the SEC. Oftentimes our personal background checks will turn up liens, state tax liens, judgments, and oftentimes lawsuits, oftentimes personal bankruptcies. Those are all good things to show bad actors. It does not make for a strong filing, but it's something that we can use in addition to the other misrepresentations, in addition to the fake returns, in addition to the wire fraud, etc. We can use that to make for a stronger case. Also want to look for unregistered brokers. Typically, these schemes get very big because they have unscrupulous people selling the scheme. So a normal investment, if you were to, sell, if you're just a normal broker, a legitimate broker selling a legitimate mutual fund, you get a commission of a couple percent at most. These unregistered brokers that will just typically work out of a boiler room, typically in South Florida, oftentimes in Long Island, New York as well. But it can be in other places, but we always see them in South Florida. We see a lot in Long Island. They'll call seniors and unsophisticated investors. They'll oftentimes get lists from other investors, or it'll be, essentially it'll be lists from other fraudsters that have scammed these folks before. So there are a database of potential victims, and they typically are targeted by these characters over and over again. And usually these guys will use unregistered brokers, again, usually in South Florida, not always, to help peddle these investments. Great example here is the Woodridge case. That was a big case that we worked. That was a $1 billion real estate scam. And that was heavily supported by the use of unregistered brokers. It made it a really big scam. The easiest thing for you to identify are the fake investment returns. So we see them in essentially all of our cases, because if our cases, if the fraudsters we're working on were actually investing money, the returns wouldn't be that good and they wouldn't be able to attract investors. So we typically see fake investment returns. Well, how are they fake? Well, they're either the numbers are made up, or they don't acknowledge the losses. So, hey, I made a $1,000 loan. This guy hasn't paid me in 9 months, and I'm still carrying it at $1,000 and I haven't shown any loss. Well, why would you do that? You do that because you still get the management fee from the investors on $1,000. If you wrote it down to $700, the management fee would be on the new asset value of $700, not $1,000. Fraudsters don't want that because they'd make less money, so they will overvalue investments to continue to capture the management fee. Let's take a look at some of these. You should be able to pick out the fraud here. It's always going to be a straight line, okay? So what we see here is we see a fraud in green, and we see real equity indices, the MSCI Emerging and Frontier Markets Index, excluding South Africa, is the brown line, and you'll see what it's done. It's been all over the place. It's been up, it's been down, it's been up, it's been down. Same with the S&P, the Standard & Poor's Frontier Africa Index. It's been up and it's been down. Oddly enough, Barack, which is a fraudulent hedge fund, which we have filed a case on, it's roughly $1 billion, is a straight line through all of this, no problems, no issues whatsoever. It's a fraud. They'll present this different ways. So here we have growth of $100,000 investment. This is the seedling fund. I don't have to tell you which one is the fraud. You may say, hey, the blue looks like a fraud as well. Well, the blue is actually it's LIBOR. The blue is a cash security. So it's essentially a treasury bill, which won't default or has not defaulted, but it won't default. US government treasury bill, plus 4%. Now, the point is that doesn't get anyone excited. So what does the seedling fund do? It says, hey, I can get you essentially a high yield return, right? See that Bloomberg high yield index, the dotted line that's all over the place? Well, the seedling fund is essentially outperforming that, or certainly up there, with none of the volatility. So the investor says, geez, I don't want any volatility. I could go into this cash LIBOR plus 4%, cash T-bill, whatever it is. If they leveraged it, they could get to that return, right? And if it's not going to default, if you just hold it to maturity, a treasury bill, then it's fine if you use leverage. It's no big deal. But why would you do that when you could do, for the same volatility, the same risk, the same movement, you could get twice the return by going into the seedling fund? So that's what the seedling fund's trying to do. They're trying to lure you into a higher return, but not a super high return, right? It's still lower, all else being equal, than the Bloomberg high yield index. But their key is here is they're targeting the folks, the seniors, the people that want the quote unquote fixed income, the steady return. They're claiming that they can give you almost a high yield return with essentially the risk of a cash security, which quite honestly, we all know is impossible. So this is a fraud. You'll see it a different way. Don't let it, whether it's a bar or a line, at the end of the day, it's still a fraud. There are no straight lines in finance. And we have the Prism Income Fund. You can see that it gives you a benchmark, and it's done twice as much as its benchmark. This raises two questions. Are you actually investing in the strategy that you say? More to the point, if there's all positive returns, 45-degree angle, it's a fraud. We can drill down to add another red flag to, oh, are you misrepresenting the investment strategy? But the first red flag here is that we have fake returns, or returns that don't seem legitimate. Again, we don't want to be fooled. Whether we see this in a line, a bar chart, or a table, it's all the same ball of wax. These are returns going back 10 years or more. They're all positive. I can assure you that if there was a fund manager that had all positive returns for this period, they would either be working at one of the big fund shops, or you would have heard of them already. Because you haven't, these are likely fake returns. You can also use something known as the Binford's rule to take a look and see if these numbers are realistic. We'll talk about that later. The key thing here that's really important is that these returns aren't super high. So when you look at the S&P 500 index, a legitimate index, 500 stocks in the US, it was up about 25 or 30% last year. It was actually up that much. You look at this fraudster's returns, and he's guaranteeing what? He's not guaranteeing 20%. He's not telling you he's going to give you 10% even. He's just essentially saying you're going to get 8% a year, 7.29, 8.47, 8.68, 9.51, right? He's giving you this steady return with no risk of loss, right? So this is the catch here, is that they're not telling you that you're going to make 100% a year, or going to make 3% a month, which would obviously be fake. But here what they're implying is that they can give you a steady 8% with zero risk of loss. Well, why are you saying zero risk of loss? Because they're presenting returns for over 10 years, 120 plus periods, that don't show any negative returns. So the implication here is you're not going to have any negative returns, even if they don't say it. And we know these returns aren't real because this isn't how finance works. We have another table here. I like this one. I like this one in particular. We have 7 years of monthly returns, all positive. But I like how the fraudster, they even, I guess they wanted to throw us a bone. They even put, if you look in August 2015, there's a negative return there. Again, this is all positive returns, right? We have from 2014 through 2019, that's 60 periods of returns or more. And there's one positive. So this is the, again, this is the, I think Bernie Madoff had when we looked at his negative returns, which he had some, Bernie Madoff had negative returns in some months, but it would have been the equivalent of a baseball player batting 950. So, okay, look, you're not batting 1,000, but you're batting 950 or 900, right? That baseball player would obviously be using steroids. You're not able to bat 950 over an extended period of time. You're not able to do that in finance either. Misrepresentations is really what we want to rack up, because we typically rack those up via email and phone, and that racks up cases of wire fraud. That helps the government because when we provide them with 5, 6, 7, 8, 9 emails of misrepresentations via electronic communications, which equals wire fraud, it makes it very easy for them to go into the fraudsters, threaten 90 years in jail, 9 years for each count of wire fraud. And typically these fraudsters will start to admit to what they've been doing when they're facing that amount of time. There's practically no way to communicate with someone nowadays without making a misrepresentation via a piece of technology: phone, cell phone, text message, email, website, you name it. That would all constitute wire fraud if they make a misrepresentation there. Private lending, private credit has been where a lot of our work's been at lately. And some of the most obvious and egregious things we've seen are loans to non-existent borrowers. This is basically when you go look at so what you would do is if you're talking with a private credit fund, you would ask them for a list of representative loans. When they provide you with that list of representative loans, if they provide you with the name, you can obviously Google that company, find out who the directors are. Oftentimes you'll see directors that are similar to the directors or the same as the directors on the fund. That would show related entity loans. But more likely you'll find essentially shell companies, companies with no operations, companies with no press releases, company with no business footprint whatsoever, a company that claims to be doing real estate and needing a loan. But when you go to the state real estate records of the state that they claim to be operating in, you don't find their name anywhere in any state real estate permits. They have no operating footprint. This will be a loan to a non-existent borrower. Okay. We also see sometimes loans, people work with accomplices, other investment executives at other organizations to make fake loans. So that's a little bit harder to discern, but if you see a lot of loans between sort of two organizations, it's worth doing some more work on the other organization because they could be related or at least be in on the scam. Double pledging of collateral is a huge one. Lots of times these fraudsters like to say that the loans are secured. It makes people feel comfortable that they have collateral, that they have some sort of security underlying their investment. And what we find out is these loans are often under collateralized. The collateral hasn't been valued by a third party. The collateral is actually trumped up. Platinum Partners is a good one, a good example of this. Platinum Partners had a Black Elk, was an oil company, Black Elk. They carried it on the books at $140 million. The amount of Black Elk as an asset, that was the value. But when you looked at some of the internal documents that they shared amongst themselves, and actually some of the related party loans that they did with themselves related to Black Elk, it had a value of about $5 million. So you had an asset which, according to internal documents at Platinum Partners, was valued at $5 million. However, on the books that they were providing to investors, that they were charging the management fee on, Black Elk was $140 million investment being carried on the books. So we have inflated valuation to rip off investors. And if anything was lent out against that or collateralized against it up and above 5 million, it was under collateralized. So that's a big problem there. Giving people what they say is a secured investment and it's not in fact secure. That's a misrepresentation. The last one, reciprocal loan agreements. You can think of this as the related party robbing Peter to pay Paul. Oftentimes, if something goes into trouble in, fraudulent fund one, what they'll do is fraudulent fund two will automatically buy the asset, carry it at the purchase price. It'll essentially bail out the first fund. The fund will look like it has sold the asset to another entity. Again, hard for investors to verify who that other entity was if they don't go through the documents or get a hold of the sale agreement. And that's one way these fraudsters are able to maintain inflated valuations using related party entities. When you look at, oftentimes we'll try to get a hold of the audited financials for the management company. And typically you'll see a fund that's presenting stellar returns, no losses, and that fund should be taking a management fee off the growth of this portfolio over time. Well, every year, but as the portfolio grows over time, the management fee should grow over time, which means the financials should look better over time. However, oftentimes when we look at the audited financials of these management companies, they don't look that good. They don't look as good as what the returns of the underlying funds that the management company is managing. It doesn't look as good as what you would think. And quite frankly, it looks usually pretty bad. We typically have negative cash from operations, negative free cash flow. We typically have a growing of accounts payables. Folks aren't paying their bills. They're keeping their bills out longer than normal. We typically see weird transactions. We typically see loans to management. We'll typically see a lot of strange things in the footnotes as well, which don't, really jive with the performance of the fund. So you're a management company, BlackRock Management Company, and if all of the BlackRock funds are doing good, then the BlackRock Management Company should be doing good, all else being equal. And we typically don't see that with a fraudulent fund manager or asset manager. So we want to get a hold of the audited financials. You want to read through all the footnotes. The first footnote you want to go to is related party transactions. The quickest way to get there is to do a Control F when you open the PDF document and put in related. It should take you to related party. You can also put in Control F will help you search through the various footnotes. You could put in special purpose entity to see what comes up. You could put in loans to see what comes up. But the footnotes is where all of the good stuff's going to be. The financials are always going to look terrible. It's a Ponzi scheme or a fraud. So, there's not money staying in the business. The whole point of this thing is for money to leave the business, to go to the fraudsters. So the financials will always look bad, but a lot of the meat that you'll need for your filing will be in the footnotes. It's interesting, when I started working on these, I was very excited when you'd find a fraudster running a scheme, and then I'd find out that this was his second or third scheme, and he'd done this before, and he has bankruptcies in the past, and he's, perhaps even the SEC has banned him in the past for a period of time. I actually thought that was going to be a bigger deal for regulators than it is. But this is something that you want to bring in, but it's something you want to put towards the end of the filing. Again, it's a bit counterintuitive, but if you put this type of stuff toward the beginning of your filing, the regulators will perceive your filing to be weak because you didn't lead with the quantitative or qualitative red flags of the current fraud. So what you'd be saying is you'd say, hey, look, there's a drug dealer here. I think he's selling drugs now because he sold drugs in the past. That doesn't work for the SEC. It doesn't carry any weight. So you'd want to build out 5 red flags of what he's doing now. And then as a 6th or 7th, you might say, oh, and by the way, you know, he had been charged for this prior. You want to tuck that at the end. You don't want to put a lot of weight on that. You want to put weight on the current facts, and you don't want to use speculation, for lack of a better word. Again, this is the government speaking. You don't want to use speculation to say, oh, he's done it before, so he's doing it again. Me, I think that it should hold more weight. But again, I'm not going after, I'm not, you know, the SEC, and I'm not paying the whistleblower reward. So we have to do what they want us to do. And what they want us to do is to show the current fraud, the quantitative reasons, what we're looking at right here and now is a fraud. Then we want to go and look at the qualitative reasons, what we're looking at right here and now is a fraud. And then the very end, the last red flag, number 9 or number 10, you can say, oh, this fund was also related to another fund that was recently shut down by the SEC, or this gentleman prior to forming this current fraud was working at Horizon Securities, which was shut down just 2 years ago for similar behavior, right? But you have to put this at the end. It's important. It sort of confirms that you're working the right case, but you can't put it high up in the filing. But it is something you need to be mindful of. So once you've done all the work, once you've looked through all the promissory notes, the offering memorandums, the prospectuses, once you've communicated with the fraudsters via email, via phone, recorded the phone calls, saved the emails, asked follow-up questions, got follow-up clarifications, asked for more historical documents, after you've requested audited financials as just part of your due diligence process to invest, once you've asked for bank information to wire your investment over, you're ready to start building the case. What you want to do is you want to have at least 6 or 7 red flags. You want to have about, each one should be about a half a page. So you should have a 3 to 4 page at minimum case filing when you when you factor in the perhaps charts, graphs, or charts, tables you might put in. You want to have about a 4-page filing with about 6 red flags at minimum. Each red flag taking up about half a page, you explaining why it's important. Putting references in to the documents that support what your red flags are. Anything guaranteeing returns, anything from the character saying that there's no risk of loss. They typically won't say it that straightforward, but at the end of the day, they say it, right? Because they know that's what the person wants to hear and they want your money. So sometimes it's pretty egregious. There's no way you'll lose money, but more often than not, they'll say, hey, look, I do A, B, C, and D, and because I do A, B, C, and D, there's pretty much no chance you can lose money, right? That's what they'll say it like that. It's just as damaging, but it's not going to be necessarily as straightforward. But you'll get it at the end of the day. So just ask. Just, you know, you're worried. You have medical bills. Your kids in Harvard, and look, you just can't take a loss in this investment. Tell them to give you a peace of mind. Let me know my investment's good. I can't take any chance here. I got screwed before. My wife will leave me if I get screwed again. You know, and they'll typically give you the guarantee that you need. You really want to use the investment and subscription documents to build the case. Those are the private things that wouldn't be available on the website. This is what helps to get you a bigger percentage of the reward because you've provided the SEC with something that they wouldn't have been able to get just on the internet. I like to Google for other lawsuits. For example, we filed a case with the SEC, which is federal, and there was actually a civil action in California state court against this fund. It wasn't from the California regulator, but the fact is it was in the courts. So the SEC oftentimes doesn't want to appear as moving late on an action. So they may, additional lawsuits or anything that's out there may prompt faster action from the SEC if they weren't aware of it already. The risk here is that if this lawsuit's out there and they're aware of it already and you file your case, you may not get any credit if they were already working on it. But again, that's neither here nor there. You want to put in the best case you can. You want to have as much substantiating evidence as you can, and any outstanding lawsuits related to fraud, related to theft would help bolster that case. The other thing is, keep in mind that we work in US jurisdiction. The way a fraudster falls in US jurisdiction is by soliciting US investors. So you can be in Kazakhstan, but if you take $1 from a US investor, you will fall under SEC jurisdiction. Obviously, if you're in the US and taking money from US investors, you're under US jurisdiction. One way that, so we want to show early and in bold letters to the SEC why this falls in their court. Why does this fall in their court? This falls in your court because the company is based in London, but they have an office in New York and West Palm Beach. Or the company is based in South Africa, but when they provided me with their investor breakdown, 30% of their investment dollars came from US pension funds. An easy way is to Google SEC Form D. SEC Form D is what typically a lot of private funds raise money under. If they have a SEC Form D in the system, that's a sort of smoking gun to get the SEC involved. But again, it doesn't matter. As soon as they take $1 of US investor money, or as soon as they solicit US investors, they fall into our jurisdiction. But we have to make that known to the SEC. When you're creating the draft filing, the quantitative data is the most important. These would be the falsified, fake, or illegitimate returns. These would be things in the private placement memorandum, the PPM, or the prospectus that are just weird or have discrepancies with what they say online, discrepancies with what they've told you via email, or any other red flags that just look strange in the PPM, any other things that wouldn't be common in a typical PPM. You want to ask typically if you can, you want to ask for their historical track record. If it's a real estate fund, you want to say, hey, can you send me, a few of your recent projects you've completed? If it's a private credit fund, you might want to say, hey, send me, send me your current loan book and, see what they send you. Oftentimes they'll omit the names, but sometimes you'll see some. You want to get as much data as you can, much information as you can. And typically it'll come together to not make sense with something else that you received. We want to show that the returns don't match the stated investment strategy. If someone says that their investment is linked to interest rates, if they're a loan fund, and if interest rates are rising right now in the market, but their returns or yields or interest rates in the funds are declining, that's a red flag. So we would show that in a nice chart, that their interest rates to their investors are falling while interest rates in the market are rising. That wouldn't make sense if you say you're a loan fund. We also want to use Benford's Law when we can. Benford's Law is a way to identify falsified and fake numbers. So typically when people make fake numbers, they do one of two things. They either use a couple of numbers a lot. They might use 8 a lot. They might use 7 a lot, or 4 a lot. Or more often what they do is they try to sort of make all the numbers sort of appear equally. So, they try to make sure that there's not too many 8s, there's not too many 1s, there's not too many 2s in their numbers. The problem with this is that's not how numbers work. What we see in nature is that typically most numbers are actually small. Obviously numbers go from 0 to 9. And typically in nature, we see ones and twos and threes more than we see eights and nines. That's just the way it works. So there is something called Benford's Law, which will help you identify falsified numbers. So oftentimes we'll do a chart showing the distribution of the numbers. We'll show that the distribution of the numbers in the financials or the distribution of the numbers in the returns that we were provided from the fraudsters do not conform with Benford's Law. Again, this isn't a smoking gun, but it's something that you can put towards the bottom. You know, maybe it's your fifth red flag, maybe it's your sixth red flag. You know, as you build your case. When you look at the qualitative side, we will handle the personal background checks. We will look for tax liens. We will look for judgments, personal bankruptcies, anything to show that this portfolio manager, one, could be at higher risk of misappropriating money. So people with financial problems, all else being equal, are more likely to steal. If you are facing bankruptcy or perhaps have a judgment on your home, you may be tempted to do something that you may have not done otherwise. But anything that we can show that this person may not have the stellar track record of money management. If you're a good money manager, typically you wouldn't have a personal bankruptcy. If you were obeying the law, typically you wouldn't have a tax lien. So we use these qualitative things, tax liens, judgments, bankruptcies, to help support our case. It's not a smoking gun. It's not even a loaded gun. It is just something that we put towards the bottom of the filing to raise questions about the character of the principals or the executives running the fund. Again, you can Google for lawsuits. If I was working on, you know, ABC Real Estate Fund, I would do ABC Real Estate Lawsuit. I would be, you know, do ABC Real Estate Defendant, ABC Real Estate Plaintiff, ABC Real Estate State Court, ABC Real Estate Civil Action, ABC Real Estate Lawsuit Fraud. So I'd be Googling these various things to see if I could get a hit. Go beyond the first page, go to the second page, go to the third page, go to the fourth page on Google. You will find things. Prior SEC sanctions or some, you won't see it a lot, but you know, if it's there, certainly add that in. And any criminal behavior related to theft. Again, we will help you with the background checks, so you won't have to worry about that. So all in all, hopefully this has been helpful. Again, this doesn't cover everything you'll see, but I want you to think about, as you fight these frauds, I want you to think about it like shoplifting. Shoplifting is going to look very different if you're in Sotheby's or Tiffany's or Cartier than it will if you're in Old Navy or Macy's. But if you're working security, I want you to understand that the features, many of the characteristics will be the same across the various shoplifters. They may do it differently. They may have slightly different techniques that they use, but all in all, it's going to feel and smell and look very similar. So that's also what we're saying here with the investment fraud. It's not always going to be the same. They will be very similar, and as you work these cases, you'll find other cases that are similar. As you work cases in the future, you will be able to reuse portions of what you've written on prior cases. That will be very helpful when you put in for the new cases. So a lot of the infractions are the same. If you're a traffic cop, you're not going to get necessarily the same. Every day it may not be running the red light. Every day it may not be speeding. Every day it may not be expired tags. But you're going to get this feel, this, you know, these 5 or 6 things that are typically always going to be there: expired tags and suspended license, broken windshield and suspended license, you know, speeding and suspended license, right? So they're not always going to be the same, but you're going to have these characteristics with these Ponzi schemes, with these investment frauds, that will help you do what? Identify them when you see them: misrepresentations, guaranteed returns, fake returns, lack of investment staff, bad actors. You're going to see these things sort of over and over, packaged in different ways. Then what you want to be able to do is split your hand into qualitative and quantitative, with the weight, most of the weight for your filing being on the quantitative. And you want to start building out that case of red flags, 5, 6, 7 red flags. So what would it be? Red flag number 1, fund returns don't appear to be legitimate. Red flag number 2, misrepresentations in offering documents raise risk. Red flag number 3, audited financial statements show firm that is losing money and heightens risk for investors. Red flag number 4, personal bankruptcies and tax liens of portfolio manager raise risk for investors. So you're building out these red flags to get this 4 or 5 page document that we can then massage for you, work with the lawyers to get it prepared, and then we can get that off to the SEC so the clock can start ticking on your action. Thanks for joining. Thanks for listening today. Hopefully this was helpful. We're always here to support you as you guys hunt these fraudsters. We're here to support if you just want to pick up the phone and ask us a question, if you want to send us a document to see if we're seeing something that maybe you're not seeing, or again, if you need any additional background checks, any additional legwork from our legal team, we're here for that as well. So thank you and happy hunting.